Hello, welcome back. So, Target, the well known discount store, is getting decimated. It's down almost 28% right now, with the rest of the retailers, like these well known discount retailers. Walmart is down as well, Costco is down as well. I'm gonna be making videos and talk about all of these because these are very interesting companies to hold, especially during a recession. So, if that happens, we want to hold a little bit of these, and if they are given to us at a better price, that's even better. So let's examine what they did in terms of their reports, of their earnings report, and this is why they went down for the most part. In the case of Target, as you'll see here, they have preparing Wall Street for a reduction pretty much. But let's see what happened. So some sales actually grew like 3% over here, as you'll see, and then an overall increase of 4% compared to last year. But the thing is that they missed expectations in the bottom line, which is the net income, of course, and Target sales fell quite sharply, as you'll see. Operating income was 1.3 billion, down 43%, ouch, from the 2.4 billion in 2021. Driven primarily by a drop in gross margins. As you can understand, margins dropped, and this is why the company lost a lot of its income here. Now, operating margin rate of 53% was well below expectations, as you'll see. And we can kind of go back here to the tool and see that margin pretty much and how it has gone down pretty significantly here. Okay. Now, Target's CEO said that freight costs were increased due to the dramatic rise in fuel prices. You would expect that, and this is what inflation will do to you. And sales of items like TVs, kitchen appliances, bicycles dropped off as consumers shifted their spending towards experience-based purchases like booking trips and going to restaurants, which makes sense. I mean, people have lost that in the past couple of years or so, and they're trying to regain that. And so this may give us an unbelievably nice opportunity here to buy a little bit of Target. So let's examine its financials. What is the company doing? Now, the P ratio is 11, which we love to see is going down, and the price to free cash flow ratio is also very low, 14.2 here. With the outstandings of the shares of the company going down as well, the company has been buying back shares, which is something else that I love to see. And it's only the total liabilities to free cash flow, which is a little bit elevated here. It's about 8 years of last year's free cash flow to pay back all the total liabilities. Now, that's not a massive problem, of course, but it's something to note in terms of debt. It may be a little bit of an elevated debt here. Now, the 5-year revenue growth has been increasing for the company. As you will see, the net income growth has been increasing as well. Now, of course, in this new report, we're gonna be seeing some lower values, and this will affect these key metrics over the years, of course. But the free cash flow margin has been pretty much positive, but not grown that much. 5-year total equity growth has been at 10%. Now, you will see here that the debt to equity ratio is a little bit elevated. You are expecting that based on what we have seen in terms of the total liabilities to free cash flow. It looks like the company is getting some debt here, which affects their total liabilities because this is extra liabilities here. And this also has a say on the return on equity, which is elevated because they are using this debt to increase their bottom line. Now, the company pays a 2.6% dividend yield, which is pretty hefty here, and it's just 40% of their free cash flow, less than 40%, which is nice to see. It's important to take a look at the trends in terms of the Target dividend payments, and you will see that it's been going up and up and up and up. So the company has been increasing their dividends since 2010. That's very reliable. It's been many years, about 12 years. Now, of course, it's not massive, but it's still very reliable. And again, 2.31 is what their dividend yield has been. 2.6 actually in the last 12 months. Okay, let's go back at our stock analysis tool here. And yeah, we have seen all these metrics here, and it looks like the company's price to book is a little bit elevated, but that shouldn't affect us too much. What we do want to see next is the actual financial statements here and what they are doing in terms of that, just to see that in a little bit more detail. You will see that the revenue has been increasing here, 72 to 1.106 here for 2022 fiscal year, and net income from 2.9 billion to 6.9 billion, very nice as well. Now, the balance sheet of the company, you will see that they have a total equity of 11.6 here and then 12.83. It looks like they're increasing their debt over here, as you'll see. They're getting some extra debt, and this definitely has a say on why the company's liabilities have been growing. And still, their total equity is better than what it used to be. So that's still a green light, really, even if they are getting quite some debt. Now, the net income of the company has been increasing, but you all see here that the net cash provided by operating activities has been increasing nicely as well. And the financing activities cash flow is negative because the company has been repaying back some debt, which is always nice to see, although they are still getting debt, so they are still looking to increase their debt. And capital expenditures here, 3 billion, and that's where the investing cash flow is utilized. And the free cash flow that the company generates is 4.4 billion back in 2018, and currently sitting at 5. A little bit of an increase, but not dramatic out here. So, not dramatic. So let's take a look at our stock evaluation tool now, because the stock price, as we're making this video, and you will see here, it's been going down a lot, and you will see that it is sitting at $1.55, which is tremendous because it has fallen off a cliff, and it may give us an interesting entry point here. So let's examine that. The revenue growth of the company has been 3, 3, 3 pretty much all over the place, 19 and 13 here in the past couple of years, but we want to go lower. We want to be especially conservative here because the company seems to be slacking lately now, and we're gonna go 3, 4, and 5. Actually, let's go 6 here and see what we can do out of this revenue growth, expecting the company not to grow that much in the next few years. The net income margins, remember, we were reading the article, and the article was talking about the margins being suppressed, remember? So operating, where was it? So there was a drop in margins. Operating margin of 5.3% is what they are mentioning here, but they were expecting pretty much a decline in margins. So we're going to go with the low, a little bit lower here, like 3, 4, and 5, which we haven't even seen here, like 3%. And the free cash flow margin overall, it's about like 70-80%, some years 120. But I think I'm gonna go relatively conservative here, 70, 80, and 90 is what I'm gonna do. And an annual return of 13% is what I typically wanna make out of my companies and out of my single stocks, pretty much. And if I hit calculate, let's see what we're getting here. Okay, so we're sitting at a point where for our high estimates, which are not too high, remember, this was a 6% revenue growth with a 5% net income margin, which the company can very, very easily achieve over here. And also the free cash flow margin of 90%, while the 5-year average has been more than that. So I think the company has a pretty much a big chance to achieve this kind of numbers here, and in this case it would make sense for us to buy this company today at at the highest price of $177, while it is at $155. Our medium ones are a little bit off, but our medium ones again were very suppressed. 4% revenue growth, 4% income margin, net income margin here, and an 80% free cash flow margin. So these are very, very conservative numbers here. I think these ones are closer to reality. And so Target right now is seeming interesting, actually, looks interesting. And this is a company that I could look to add to my portfolio. The only thing that I am a little bit curious about is whether there's going to be a higher decline, really. A steeper decline, because what the market is doing right now is pretty much destroying everybody. And so as we're progressing through that, I wouldn't be surprised if this stock goes down a little bit lower and gives us a better entry point. So I'll probably be on the look for that, because at this price I'm probably still a buyer, or at least I'm opening up a position on this one, because I do want to add some more discount stores to my portfolio, especially at this current market situation. But again, it may be worthwhile to just wait a little bit and see whether it drops below 140 or something. So thank you for watching the video. I hope you enjoyed it and gave you some ideas about Target. I'm gonna be creating more next, probably examining Walmart and Costco as well. And there is a lot going on in the markets right now. But thank you for watching this one, and remember to leave a like and subscribe if you're not a subscriber. And you can also become a Patreon and gain access to this tool that I'm using here in my videos. Just look in the description box below. There, all the links are there. And yeah, I'll see you in the very next video, guys. Bye bye.